Hello, everyone. This is a class of macroeconomics in the global context. And I'm glad that you can come and join us today. For the ones who are now watching the video, who cannot join the class, don't worry, I will not mark you absent because I know this is a special arrangement. Now, for the first 6 units, okay, including our midterm test, we basically were talking about the first component of macroeconomics, which is measurement. In order people to evaluate the economic condition of a country, we need different types of measurement. It's almost like when you go to a clinic to see the doctor would do something to find out how healthy or how not healthy you are. Now, if you can remember, what are the major types of measurement we usually take to evaluate an economy? Anyone?
To measure the economy,
Yes,
GDP,
exactly. GDP,
consumer price index, and unemployment rate.
very good. Those are the three major ones. So sometimes when you talk to people and ask them about the, you know, economic condition of their country, okay, they probably will tell you something from a very subjective perspective, okay? But these three types of measurement are relatively objective. Doesn't mean that they have no uh, limitations, right? They do have limitations, but at least when we talk about the overall economic condition, those are three very important tools for us to get a sense of how good or how bad the economy is. Why is it important to a business person? Because when we think about whether we want to operate a company in a particular country, whether we want to invest in a particular country, this type of measurement will help us to make better decisions. Okay. Now, after the midterm test, we are now coming to the second half of our course, which is about the second component of macroeconomics, which has to do with policy. Now, why would do we need to talk about policy? Well, remember, like when United States experienced the Great Depression back in the 1930s, okay? At that time, the government thought we didn't need to do much. By just relying on supply and demand forces, the economy would be back to normal. Okay, so this is what people used to think. But the painful experience of the Great Depression taught us a lesson. Sometimes free market itself is not very efficient to correct itself. Now, doesn't mean that market economy is not working. No, market economy is still very, very useful. But sometimes we may need some policies to help the economy to get back to a better state. So because of that, the second half of our course is about what are the policies government and central bank can do. Okay. Now I think you should have watched a video that I posted last week, how to understand the economic end machine, right? That I find to be one of the best videos regarding macroeconomics. Now, according to that video, it talks about our economy is like a machine. Basically, the economy is based on the productivity of the country. However, interestingly, there are ups and downs. We call it business cycle or economic cycle. Now, for people who have watched the video, do you still remember what causes the business cycle to happen? Anyone who have watched that video regarding like the economic machine? What leads to the ups and downs of our economy? Can't quite remember. Now, basically, the business cycle or
The recession time and
yeah, but why?
expansion.
Yeah, but why our economy is usually like this rather than like going up smoothly?
Because of the interest rate changes.
Yeah. So basically, as you said, it has something to do with the interest rate, but the core element is about credit.
Yeah, borrowings.
Because people do not spend and invest based on only how much they have. They borrow money to spend, they borrow money to invest. Now, that actually can be a good thing because think about this. If you have to save enough money to buy a car, to save enough money to buy an apartment, it may take you years for you to do that. But now you can borrow money from the bank and then you can drive your car now, or you can live in a house, live in an apartment now, right? Then you pay, obviously you need to pay the bank back. However, this whole uh, element of credit would lead to ups and downs of the economy because when, for example, people they borrow money, they spend, they invest, the overall assets can be driven up. That may lead to their like ability to borrow even more money. But one day, maybe there's a change of the interest rate policy. Once the asset values have been changed, then all of a sudden, the borrowing power of individuals, of families, of companies may also be changed. So basically, credit, the expansion and the contraction of credit would lead to the ups and downs of the economy. Now, there are two major types of policies that the central bank and the government can do. Today, we're going to talk about the policy that is conducted by the central bank. And we call it monetary policy. Monetary policy. Now, you know what? When you write your final exam, okay, you may sometimes forget about which is which is fiscal policy, which is monetary policy. And you know what? All you need to do is to take out your dollar bill. And then when you look at your dollar bill, you should be able to see Bank of Canada. Okay? That reminds you is the Bank of Canada that is responsible for money. And because of that, the Bank of Canada is also responsible for the monetary policy. Now, if the Bank of Canada is responsible for the monetary policy, who is responsible for the fiscal policy. It's the parliament, okay? The parliament of a country. So in the case of Canada, now our parliament is led by Justin Trudeau, who is our prime minister. Okay, so basically it's just Justin Trudeau and also the finance minister, Freeland, Minister Freeland. They are basically with also the Liberal Party to be responsible for the fiscal policy. Now today, let's talk about monetary policy. Okay, now in order to understand monetary policy, first of all, we need to understand what is money. I think we've talked about it very briefly, okay, but let's have a review of that. Now, so far, I wonder if there's any question. So far, so good?
Yes, Professor.
Yes, very good. Now, let's talk about money. Now, what do you think are the major functions of money? What are the major functions of money?
It raises the spending power of a person.
Okay,
Yeah, if we
it's
have
about
money, we can
spending.
buy anything.
Okay, you use
Yeah,
it
so
to
buying
buy
capacity
things.
increases.
Very good, very good. Now, in general, what Hanit has just said is what we call transaction. Money can be used as the medium of transaction, meaning that even though this piece of paper by itself may not be that useful, but you can use this paper to buy, I don't know, a bubble tea, maybe French fries, whatever you want. Okay? So the first function of money is the medium of exchange. What else can the money be used for? Now think about this. If you try to talk about the value of something, okay, for example, the value of this eraser, okay, you won't say, oh, this eraser is worth half a cup of coffee. You won't say it like this, right? Or you won't say it like, oh, this eraser is worth 5 grapes. This is usually not how you describe the value of something, right? You would say, oh, this eraser is worth $1. So money can also be used as what we call the unit of measurement. Oh, this pair of scissors is worth $4. Okay, this pencil is worth. Oh, can you see that? Yeah, this pencil can worth I don't know, like $2.50. Okay, so this is what money can also be used for, is the measurement unit. The third major function of money is what we call the storage of value, meaning that now if you have some saving, right? One of the easiest way to keep your saving is to keep it as money, because if you keep it as something else, they may be rotten. Okay, think about if you try to keep all your saving as, I don't know, potatoes. After a few months, the potatoes may go all rotten. But then if you keep your saving as money, then money can be kept for a long time. Okay, so remember the 3 major functions of money is the unit of measurement, is the storage of value, and also is the medium of exchange. Now, I wonder if there's any questions so far. Any question?
Professor.
Okay, very good.
No, sir.
Very good. Now, next Wednesday, when we meet, I'm going to show you a video that talks about how the US dollar bills are actually made. Okay, this is actually quite interesting. I'm pretty sure most of us have not actually seen how a dollar bill been made. Now, if we are living in a society without money, that can be very inconvenient. Because number one, if you want to get something, right? Let's say you have 2 apples and you want to get some eggs. You have to actually find the person who not only has eggs, but is willing to trade the eggs with your apples. That is very inconvenient. Now, because of money, we don't need to find that particular person. All we need to do is to use money to buy the eggs, okay? And then I can sell the apples for money. So you can see money is very important in terms of keeping our economy to flow. So remember, when you when you take your final exam, it's very likely that this question will be asked. What are the 3 major functions of money? Medium of exchange, unit of account, and store of value. Okay, keep that in mind. Okay. Now, in the past, money usually has these 4 major characteristics. Money is usually portable, divisible, durable, and also stable, meaning that it is stable enough to hold its value over time, apart from minor fluctuations. That's why if you read the novels, if you watch the movies, they are talking about people in the past. They used to use gold coins or silver coins as money. Now think about gold coins and silver coins. They actually all share these 4 major characteristics. However, as our technology is improving, nowadays, these 4 characteristics may no longer be relevant. I guess the bottom line of money at the end of the day is whatever sellers are willing to accept. Now, let me ask you a question. Have you heard of cryptocurrency or Bitcoin? Has anyone ever heard of Bitcoin, cryptocurrency? Never?
Bitcoins?
Bitcoin, yeah, or cryptocurrency.
Oh, crypto, yeah.
Yes.
It's like a virtual money.
Yeah, exactly. Now, do you think they are actual money? Are they real money?
I have very less knowledge about this, so I can just guess, but I think it's not the real money.
Okay.
Yeah, it's a
Okay.
virtual, and I think it's a fake like that. It's
Okay. So how
it's not
Harpreet,
a real money.
I
do you
can
think
say
is
it holds the value similar to what our money is, but we can't see it, we can't touch it. I'm not sure if we can purchase something or not, but yeah, if you wanted to purchase cryptocurrency, then you have to invest with the actual money you have in your account, and then you can buy that crypto. But I'm not sure if you can what else we can do.
yeah. You know what? Harpreet, do you want to say something too?
No,
I think there's no definite answer to the question, at least at this point. Okay. Now, some people may argue you can use Bitcoin, you can use cryptocurrency to buy things online. You can transfer the cryptocurrency to another person's account. That is pretty much like money. But some people, they have a very different view. They say that number one, for example, Bitcoin, the value is not stable. If you look at the value of Bitcoin, it fluctuates very significantly. Also, some people may say because those cryptocurrencies are not endorsed by a government. Now, for example, if you're talking about Canadian dollars, right? The Canadian dollar is endorsed by Bank of Canada. If you talk about US dollar, the US dollar is endorsed by the Federal Reserve. But for cryptocurrency, no, they are not endorsed by any government or any like central bank. So whether the cryptocurrency is money or not, I think is very debatable. It also, I think, depends on different countries. Some governments, they actually ban people to use cryptocurrency. But some other countries, they are more like willing to accept people using cryptocurrencies. Okay. So right now, I think, this question doesn't have a very definite answer. It's still very debatable. Now, let me ask you another question. Do you think credit card, for example, MasterCard, okay, is it a or Visa card, is it money?
It's
You
it's a
use credit
credit in
cards to
form
buy
of
things. Is it
money.
money?
It's a borrowing in form of money. Like we can just use it, and then we have with the promise that we will return it in future.
Okay, you are so correct. Okay, so because of that, credit cards are not considered to be money because you actually have to use money to pay back the company. Okay, so credit card is almost like a loan. You are borrowing money and then you need to pay it back. Now, unfortunately, a lot of people, they don't have this concept. When they use the credit card to buy things, they think that they're using money to buy it without knowing that they're actually borrowing money to buy it. And then up to a point, they may not be able to pay back the debt. So remember, credit card itself is not money. It just allows you to borrow money to buy the different things. Now, in the past, we have what people call the commodity money, meaning that like the money is like in the form of a coin, for example, can be made by silver or gold. And then people started to come up with dollar bills. But at that time, the dollar bills, the paper bills, they were basically what we call commodity backed, meaning that people can convert the dollar bills into silver or gold. There's a guaranteed amount of silver or gold you can convert your dollar bills into, but not anymore. Nowadays, our money is called fiat money, okay, meaning that it's no longer supported by a definite amount of gold or silver, okay? Now, if you still remember, I asked you this question before, and see if you can still remember that. If our money is no longer supported by a definite amount of gold or silver, why do we still trust the money that we have? How can the central bank convince us that our money has value?
There's a stamp of a bank of like the president, the Reserve Bank, and then there are certain things that we can feel on the note or stuff like that, that this is the original money. Basically, the answer is that the stamp that matters. If that is on the on a bill, that means it's it's a money that is that has been uh, printed by the central bank, and it worth the same amount which is written on the bill.
Very good. So first of all, if we look at the dollar bill, we see that it is endorsed by the central bank. For example, the Canadian dollar is endorsed by the Central Bank of Canada. The other thing that the Bank of Canada tries to convince us the dollar bill is worth a certain amount of goods or services is, if you still remember, there's a concept called inflation targeting. Basically, the Central Bank of Canada is saying, hey, you know what? We guarantee you that the Canadian dollar would not be losing value in a significant way. We will ensure that the inflation is between 1% and 3%. So this is how the Central Bank of Canada can give people confidence to hold on to the Canadian dollars, okay? And not only the Bank of Canada, but nowadays many central banks, including the Central Bank of India, if you still remember, okay? The Indian Central Bank, they also have an inflation target around 4 or 5%, okay? So it's it's a very important guarantee to tell people, hey, you know what? You don't need to worry. Your money, even though there may be inflation, but the inflation is within a certain range. Now, so far, so good?
Yes, Professor.
So we've talked about this question here. Now, what is an asset? What is an asset?
Asset is something that we purchased from with like we did a transaction, and then we purchase something which has a it will be an equal value in future, or the value will rise in the future.
Okay, so basically, an asset, as you said, is something of value. Now, in many cases, the assets that you own, like some of the assets may even generate cash flow to you. Okay, now you may be wondering, oh, what are some examples of that? Now, think about if you are buying a house, okay, and then you rent your house to someone else. You are the landlord. So every month, the house would generate rent to you, right?
Yes.
So there are also other kinds of assets that not only would not increase in value, but will decrease in value. For example, if you buy a car, okay, if you buy a car, then the value of the car would keep depreciates, right? So even when we talk about assets, there are two types of assets. One type of asset, you may be able to preserve the value or even enjoy the growth of the
Yeah,
value.
appreciation or depreciation.
Exactly. But then there are other like assets that usually would go through the depreciation process. Okay. Now, you know what? I find that is around 12:40, and I want to give you a break. Now, I wonder, um, do you want like say a 5-minute break or a 10-minute break? What would be sufficient for you? Now, if the break is longer, that means we'll end the class a little bit later, right? So to me, it doesn't matter. But if you think you need a longer break to get a drink, whatever, I'm fine with that.
If others are agree, can we do like no break? Is it fine with others? Then we can finish it as soon as possible.
Okay. So you don't need like the frequent breaks, right?
Yeah, but I need to get consent from other classmates.
Yes. Oh, it's not that hard. We don't have a large class today. So
Yeah.
Harpreet and Pradeep, um, do you want more frequent breaks or do you want it to be like the usual ones?
We don't need break, Professor. We can start class,
Oh,
continue, and we'll finish earlier.
okay, okay. Or maybe, you know what? Maybe later I'll give you maybe a 5-minute break, okay? In
Yeah.
case
Okay,
if anyone needs to go to the washroom or whatever, okay?
Yeah.
okay,
Right
Yep.
now we all are good. I think so.
Okay, okay. Sounds good. So I'll continue, okay?
Yeah.
okay, Professor.
Yes. Now remember, one of the reasons why we have the business cycle or the economic cycle is exactly because of the changing value of the assets. Now, for example, when people assets are worth more, they can spend more money, right? Their wealth has been increased. They can spend more money. It also allows them to be able to borrow more money, because think about if assets are being used as the collateral. When the assets are getting more valuable, that means they can borrow more money accordingly. But at the same time, if the assets becoming less valuable, that will affect people's spending, that will affect people's capacity to borrow money. That's why credit is probably the most important element that contributes to the ups and downs of our economy. Now, these are some examples of the assets, including shares. People like to buy company shares as an investment. And you know what? When you get older, when you have a more steady income, right? Keeping all your saving as cash may not be the best idea. Because of inflation, your value of the cash tends to decline. I don't mean that you should not have cash as saving, right? We all need extra cash to pay for, sometimes unexpected bills, to be able to cover some of the unexpected expenses. But if you have a lot of saving, right, you probably want to put aside some of them to make different types of investment. Buying shares is definitely one of the alternatives. Okay, now some people may actually be owning a business. In fact, even when you are talking about buying shares, that itself is already owning a portion of the company. Now, you may not be thinking about it like this, but if you buy the shares of Apple company, you are actually owning a certain portions of Apple's ownership. Yeah, you know what? Your properties would be your assets, your cash, your cars, all those belongings can be counted as your assets. Now, let's talk about how money is created in our society. Now, your immediate response may be that, oh, isn't money created by the central bank, right? If you look at the dollar bills, if you look at the coins, right, they are basically made by, the central bank or endorsed by the central bank. But in reality, that is only 50% true, because money is created by the central bank, but is also created by private banks. Now, you may be wondering why it is the case. So let's take a look at it. Now, here we are talking about credit cards are not exactly money. Okay, keep that in mind. Credit card simply means you are borrowing money to spend. So credit cards can be considered as a loan, not money. Now keep that in mind, right? When you take your final exam, when being asked such a question, are credit cards money? You should know the answer. Credit cards are not money. Now, the money is created by the central bank, but also by the commercial banks. Now, why is that the case? Now, in order to understand, we need to understand how exactly the banking system works. Now, first of all, let's talk about what the central bank is. In Canada, the central bank is called the Bank of Canada and is a public authority that regulates Canada's banking system and also controls the money supply. The Bank of Canada, number one, is the banker to the banks and the government. Now, what does it mean by that? Meaning that, if the banks, right, they need the central bank to work with them. Number two, the lender of last resort. Now, this is a very important concept. Has anyone ever heard of the term bank run? Bank run. Does anyone know what bank run means?
Like running the operations of the bank.
Yeah, basically, you know what? When you deposit money to a bank, right? The bank is not keeping your money there, just letting it to sit there, right? The money would lend the money to other people to invest, to spend, and that's how a commercial bank makes money. For example, if you deposit money to an account, you, let's say, are being paid 2%, okay? When the bank lends the money to another person and charges that person 5%. So the bank is making a profit of 3% interest rate difference. Does it make sense?
Yes.
Now, this system has a major weakness. You can imagine if a lot of people are rushing to the bank and ask to get back their deposit. Do you think the bank has enough money to pay back those people? Probably not,
Yeah.
because most of the money has been lent to some other people, right? So if that happens, I guess a bank would very likely not be able to pay back the people who have deposited the money. We
Yeah.
call this situation the bank run. Okay? Now, one of the functions of the central bank is to become the lender of last resort. That means, for example, by the way, Hanit, which bank do you use?
RBC.
RBC, okay.
Yeah.
Same here. I also have accounts at
I have a
RBC.
question before we go into it. I was wondering why, like in my home country, we get a lot, like literally a lot. We call it interest on our savings. So like fixed deposits or recurring or some stuff like that. We get 7 to 8% per annum. So it's something like, even if somebody has lots of saving, what we usually say in our home country is, if your like elders saved a lot of money, you can sit back home according to the inflation rate and all that stuff. A person a family, like the newer generation, can sit back home and they can manage their expenses through the interest they are getting on the fixed deposit, which is reality. But the thing is, why here we are not getting that much interest on the saving?
Now, that is a very, very good question. Now, first of all, you may be thinking that, oh, if I can put the money into a saving account and get, I don't know, 7 or 8%, let's say, right?
Yeah.
That's a good thing to you, right?
Yeah.
Now,
And
but you've got to remember, for any such kind of economic issue, there are always winners and there are always losers. Now, the thing about high interest rate, for example, like India, right?
Yeah.
The people who have money and put it into the saving account, they obviously like it because they don't need to do much, and
Yeah.
then they can be earning 7 or 8%.
Yes.
But imagine if you are the one who need to borrow money, right? You need to borrow money, I don't know, to buy a house, to run your business. I suppose the interest rate is also very high.
Yeah, I think it's around 15 or something.
Exactly. So first of all, I want to answer your question by saying that it doesn't mean that the higher the interest rates is better. It means it basically is saying depends on what groups of people you belong to. Okay?
Mhm.
In fact, lower interest rate environment can be good to people who want to start their businesses, who want to borrow money, who want to use the money by borrowing it to do many different things. So generally speaking, the interest rate, if it is high, it
Mhm.
may not be a good thing to many people. Okay?
So
Now
I
I
should say
yeah,
that this policy in India, in my home country, is somewhat wrong. Um, like is not wrong, but like I'm not the economist of India, but what I can say is that this policy doesn't benefit a lot of people. So rather than giving maximum, so like I'm still wondering what like they want the bank, mm, Indian banks, they want every other person to deposit some amount in the bank so that they can get interest, and then interest rates are very high and people just love to deposit the bank money in the bank. Now on the other hand, so they are charging much higher interest rate from the lenders so that they can make profit. So basically the bank profit is interest rate of the lenders minus the interest they give to people,
exactly.
and then that's the profit, but like
Yeah.
we can say that this is not a good thing for a economy to have higher interest rates on both the sides.
So your question is why they don't lower the interest rate? Is that what your
Yeah.
question is?
Yes.
I think this is a very, very good question. Now, the thing is, go back to inflation, right? Remember, one of the objectives of a central bank is to keep the inflation at a relatively low level.
Yes.
Now, I suppose the one of the major factors that the Central Bank of India needs to consider is the inflation rate. The reason why the interest rate is so high has to do with making sure that the inflation would not be too high.
Okay.
So they need to use the interest rate to regulate people's spending and investing. Now, going back to your example, let's say if the Bank of India, the Central Bank of India, right, has decided to lower the interest rate. Now, that means people may find it not as attractive to put the money in a saving account. And
Yes.
on the other hand, people are also more willing to borrow money. Make sense?
Yes.
But let's not forget that means more money would be borrowed. People would use the money from the saving account to do different investment. That would drive the price level of the goods and services up. Now that would lead to higher inflation. Okay?
Yeah. And then I also um heard from the video that one's borrowing is another person's income.
Exactly.
So
Yeah.
if in so borrowing rose, then the income will also rise, and the purchasing power will automatically rise, and the
Yep.
businesses will increase the prices.
Yes. And then exactly. That would lead to inflation, right?
Okay.
Once inflation is higher than the, for example, 5% level
Mm-hmm.
targeted by the Central Bank of India, right? Then
Mm-hmm.
people may think, hey, you know what? The Central Bank of India, they are not serious about their inflation target. Okay.
Yeah.
End up, people may just keep borrowing more money and to spend to invest because the interest rate is low. And if the inflation is getting higher and higher, up to a point, people would just say, you know what? I don't really believe in those so-called targets anymore, right? You don't want people to lose confidence in the inflation target set up by the central bank. So
Yeah.
usually the central bank will look at the inflation rate and to adjust the interest rate policy or any corresponding policy to make sure that the inflation is within the range. But the side effect is, as you said, sometimes the interest rate may be set too high because they want to keep the inflation at a certain level.
Oh, I see.
Yeah,
And is there a difference between a central bank and a reserve bank, or they're just
they are the same. It's just that in different countries, they
okay?
call it differently. I think in India, you
Yeah.
call it the Reserve Bank, right?
Yeah, Reserve Bank of India, the RBI,
Yeah,
and here
that is the same.
we say
The same. Yeah,
the Central Bank of Canada.
exactly. Yeah. For example, in United States, they call it the Federal Reserve, which is
Oh,
the central bank of United States.
okay. So it's just a name given to it.
Exactly. Yeah,
Okay.
it's just the name. And the final function of the Bank of Canada is to issue the bank notes, right? That's why when you look at the paper bill, you see Bank of Canada.
Mhm.
Now, you know what? It's 1 o'clock. Why
Mhm.
don't we take a 5 minute break, okay?
Okay.
And then we'll continue our discussion. And in the meantime, if you can think of any question, feel free to raise it. I really enjoy, answering this, and hopefully the discussion can make us like having a better idea of what has been discussed.
Yeah.
So let's resume at 1:05.
Okay.
Thank you.
Thanks.
Hello.
Hello, Hakeem. Good to see you.
Yes.
You know
Yes,
what?
see you.
We're just having a break now, and the
Okay.
class will resume in 1 minute.
Okay.
And also, I just want to let you know, Hakeem, um, like you missed the first hour, but that's okay. You will not be marked absent. The recorded video will be posted later.
Okay.
So you can always watch the first half of the video when you have time.
Okay.
Yes.
Thank you, sir.
Any questions so far regarding the assignment, regarding, you know?
Not yet. No, not really.
Okay, I just want to let you know, I'm still in the process of grading the work, including the
Okay.
midterm test. Just,
All right.
bear with me, okay? Because
No,
now
it's
we have
okay. It's okay, sir.
such a large class of almost like 50 students.
All right. That's good.
Yeah. Okay, so welcome back. Now we have just talked about at the first half of our discussion, what is money? Now remember that money has three major functions: the medium of exchange, the storage of value, and also a unit of measurement. We also talk about the characteristics of money, although nowadays some of those characteristics may no longer be that relevant. Now we are talking about the banking system. Now for the banking system, there are two major parts. The first part is what we call the central bank, or as Hani has just said, for example, in India, it's called the Reserve Bank. That is the same thing. But then we also have a whole bunch of commercial banks. For example, in Canada, we have Royal Bank, Bank of Montreal, TD Bank, Scotia Bank, etc., etc. So the banking system is made up by both the central bank and a whole bunch of commercial financial institutes. Now let's take a look of how exactly money is created. Now, as we have said, the Central Bank of Canada basically is trying to assure that we don't need to worry about the money losing value. The Bank of Canada says we set the inflation target between 1 and 3%. Whenever you see the inflation is getting close to 3% or even over 3%, you know that the Bank of Canada is going to do something to make sure that the inflation is back to the 1 and 3% range. Or if you see that the inflation is getting lower than 1%, you also can foresee the Bank of Canada is going to do something to push the inflation back to the 1 and 3% range. Now, this is actually very, very useful for you to know that. Think about if you are running a business. By looking at the inflation rate, you get a sense of how the interest rate policy may change. Now let's talk about how money is being created in the first place. Now, we actually have different types of commercial financial institutes, including commercial banks that are the ones we are most familiar with. And then there's another type called the credit unions. For example, there's a very famous one called Coastal. They are not exactly banks, but they have certain functions of a bank. And then we also have trust and mortgage loan companies. Now, how exactly a bank makes money? First of all, a bank would ask you to deposit money in their accounts. They would give you certain interest as the reward. And then they will use the money and lend it to someone else. And then they make money by the difference of the interest. For example, they give you 2%, but then they charge another person 5% when lending the money to them. That's how they make money. Now, nowadays, obviously, a bank doesn't only make money by the interest difference. They offer all types of services, and there's no free lunch. For example, if you want to transfer money from your home country to Canada, they would do it for you, but they charge you a fee. So the banks, they take your money, they don't let it sit there. They can lend out to other people, or they can invest in assets such as bonds or other financial securities. Now, the banks, they don't need to keep all the money behind. They lend out actually most of their deposits. Now, suppose you deposit $100 and the reserve ratio, that means how much money the bank has to keep behind. Okay, let's say the reserve ratio is 10%. How your deposit impacted the money supply in the economy. Let's take a look. Now, this is how it works. If you deposit $100 to a bank, then the bank has to hold 10% because of the regulation. Now, I suppose the bank probably wants to lend out all the money, right? But the Bank of Canada and the regulator would not allow that to happen. They would say, hey, you know what? You need to keep at least 10%. And that 10% now is an example, okay? I'm not saying that it's 10% in Canada, but I'm just saying, like, if the reserve ratio is 10%, that means $90 is being lent to another person, right? So let's assume someone who has borrowed the $90 for whatever reason puts that $90 to the bank as deposit. Then again, the bank would keep 10% of the $90, which is $9, as the reserve, and to lend $81 to another person. And then think about the third person who has borrowed the money, the $81, would actually deposit the money into the bank. The bank keep 10%, which is $8.10, and then to lend $70.90 to someone else. So interestingly, you see that commercial banks, they help to create money because of this, what we call fractional reserve banking system. That means each commercial bank doesn't need to keep 100% to be held in reserve. They can actually lend most of the money, most of the deposit to someone else. And commercial banks, in that sense, are creating money. Now, I know this concept sounds a bit abstract, but I wonder if there's any question. So far, so good?
Yes, sir.
In other words, you may be thinking about money only as the dollar bills and the coins, but that is not true. Money includes dollar bills for sure, includes all the coins, including the quarters, the loonie, but then it also includes all these money created by individual commercial banks. So because of that, you can see the reserve ratio makes a difference. If a country wants to decrease the money supply, one way to do it is to ask the commercial banks to keep more money behind. In other words, the central bank can order the commercial banks, hey, I want the reserve ratio to be increased. So instead of lending 90% money to other people, I want you to lend only 60%. You need to keep 40% as the reserve. Now, in that case, all of a sudden, the money supply would decrease significantly. A lower reserve ratio means more loans, and it also means more money supply. Now, suppose someone opens a new bank account for $1,000 and the reserve ratio is 5%. How is money supply impacted? The money supplies consist of currency in circulation, including the dollar bills and the coins, but also the deposits in bank. As the deposit increases by $1,000, money supply increases by $1,000. But that's not it, because the bank only needs to keep 5% of $1,000, which is $50. They can use the $950 for new loans. And then remember, the new loan for the person who borrowed the $950, put it in the bank as the deposit, that will create another round of money. So when loans are made out, they will be spent, money will return to the banking system eventually as new deposits. Turn out, the money, the deposit would go to different rounds and money supply would be increased accordingly. When we are talking about a 5% reserve ratio, okay, you can imagine there's so many rounds of new money being created. Now, this is how you can find out at the end how much money, how much new money is being created. And this actually is not difficult for you to calculate. Is $1,000, which is the original new deposit, divided by the reserve ratio. So 1,000 divided by 5%. So at the end, there would be rounds of money being created. The overall money being created by this initial $1,000 would be 20,000. So let me repeat it once more. Is the initial deposit divided by the reserve ratio. 1,000 divided by 5%, which is $20,000 being created. Any question?
All good.
Yeah. So you can imagine.
I have a question.
Sure.
That 5% is decided by the
Yeah.
central.
Yeah, that's a very good question. Usually, the central bank or the regulator, they would request the commercial banks to have a certain reserve ratio, right? So, if you leave it to the commercial banks, they probably would keep the reserve ratio as low as possible, right? But that would not be safe to the overall banking system.
Yeah.
Let's imagine the commercial banks, they are so aggressive. They want to lend 99% money to the borrowers so that they can make more profit, right? But then the regulator, the central bank, have to balance between the risk and the profit of the commercial banks. And they would say, hey, you know what? No. You cannot lend 99% of the money to people. That is too dangerous. That is too risky. What if a lot of people want to get back their money? You don't have the money to give them back. So they would come up with a reserve ratio so that on one hand, commercial banks can lend money to other people to make profit, but not to an extent that they cannot keep, the like financial system safe.
So what if by any chance someone is not able to pay whatever they borrowed and they didn't make any asset, so they have nothing to liquefy to pay the.
That is a very, very good question. That is exactly why we have the central bank. For example, let's say, I'm just making it up, okay? Don't worry when you have money in Royal Bank, okay? I'm just making this up. Let's say Royal Bank has lent a lot of money to me, okay? Let's say, I don't know, I'm just making it up, like $100 million, okay? I end up don't have the money to pay back Royal Bank, okay? So Royal Bank would need to write off the debt, meaning that Royal Bank would take it as a loss, okay? Now, Royal Bank is such a large commercial bank, and even 100 million may not be such a big deal to them. But if you imagine, like, someone has borrowed, I don't know, I'm just making it up, but like $10 billion and end up not being able to pay back Royal Bank. Now, Royal Bank may be in more trouble then. That's why they need, for example, to talk to the Bank of Canada. Hey, you know what? Now, you know what? We have lost a lot of money. In the meantime, our financial situation is quite tight. And the Bank of Canada may be like lending money to Royal Bank to help Royal Bank to overcome the difficulty. That's why the central bank or the Reserve Bank in India is also called the lender of last resort. It's exactly because in the past, when there was no central bank, there were many situations a commercial bank didn't have money to pay back the people who deposit the money. Okay, so they will end up go bankrupt. So when they went bankrupt, it's not only like a company went bankrupt. We're talking about so many people who deposited the money in the bank would also lose all their money, right? The setup of the central bank is exactly to prevent this to happen.
But then that's sure that the person who has deposited the money in the Royal Bank will get their amount back.
Yeah, I think in Canada, you are guaranteed a certain amount. I'm not 100% sure, but I think it's around 100,000. In other words, if you have like a lot of money being deposited in, say, the Royal Bank, right?
Yeah.
At least you're guaranteed you will get back 100,000, even though the bank goes bankrupt. Okay. Now, but don't worry. Okay, I don't think it's likely to happen.
Oh
Okay.
yeah.
But I think in Canada they do have that kind of guarantee. So that's why people would suggest if you have a lot of money, right? You don't put all the money into one bank. Because if you say deposit in Bank of Montreal, Royal Bank, TD Bank, right? Then you get like 100,000 for each bank as the guarantee. So you get 300,000 guarantee.
Oh, okay. And no matter how much do we have, like if we have less than 100,000?
Oh, if you have less, that's even easier, right? They will guarantee you up to 100,000.
Okay.
So if you have less than that, that means you are guaranteed to get that money back, regardless of the financial situation of the bank.
Oh, I see. And in Canada, this policy is for every bank or?
Yes, I think so. I think like I'm just not 100% sure about whether it's 100,000 or not, which you can easily
Yeah.
check it. Yeah, but I'm sure there's such kind of policy. The good thing about this is it's exactly because people are guaranteed they can get the money back. That would actually make them not having any rush to take the money back.
Yeah.
Yeah, so that would end up you don't see people in Canada, for example, would be very anxious, keep thinking about getting the money back, right? Because they know, yeah, you know what, my deposit is guaranteed up to that much, right? So I don't need to worry about getting the money. The thing about getting the money would actually create another problem. Where do I put my money, right? So usually people they would rather leave the money in the bank account unless they feel there's a risk that they may not be get back the deposit. But in Canada, they give you a guaranteed, so that you don't need to worry about losing the deposit.
Okay.
Yeah.
Thank you.
I'm not sure if other countries are exactly like I know some countries are like this too, to guarantee a certain amount. Do you happen to know in India, do they have such kind of
No, that's what I'm worrying about because
policy? Oh,
I deposited some
oh,
money and then I was like, what if? But like I deposited into a government affiliated banks, so they are
I see.
government banks. Not sure. I haven't heard of this situation earlier, but um, it's kind of sometimes if I have
Okay,
to
okay.
convert like the money, I would say like it's almost around $200,000. So the Canadians, so like um, yeah, yeah, somewhat here, but not less than that.
I
So it's
see.
like sometimes I feel like I should bring it up here. Sometimes I feel like I'm
It's
getting
safer.
lost. Yeah, I'm getting interest, and it's like a money is getting interest, and it's just multiplying over there. So I should just keep it over there. But yeah, sometimes you never know what the economy will be in future.
Yeah, I guess you can look at the history, right, of the Indian banking system. I don't know very much about it,
Yeah.
but my overall impression is the Indian banking system is not bad.
Yeah,
Yeah,
it's pretty good.
yeah,
It's a trustable banks, like
yeah,
we can trust the Indian banks.
yeah,
And yeah, the digitalization and all that stuff is all good.
yeah. I
Yeah.
think that also explains why, unlike other markets, the banking system is very much regulated. It's because think about this, we're not talking about a regular business, right? Then buy and sell things. You're talking about uh, an institute that actually takes people deposit. When
Mhm.
people deposit money to a bank, they don't like they basically um assume the bank would take care of the money
Yeah.
very safely, right?
That is why now I can relate why banks go after going for a FD, like a fixed deposit. Banks just initiate every, like they just ask every other customer to get an FD, then they can have the certain period of time to return back the money and the to give the interest, because eventually they might invest in shares or they might invest somewhere, and then they have that period of time. Like what happened with me recently is they reserved my some of my money in a 15-year program, and I'm
Oh,
getting more than double. So it's like my money will not double, it's like more than it's almost like almost 3%, like less
mm,
than, but almost 3% I'm getting back. So is that, sorry, not 3%, but 3 multiply. So yeah, 3x. So yeah. But they said for 15 years, it's a very big period of time.
yes.
And now what I'm thinking of, I don't know, after 15 years, when I'll go check my money. So the it will hold the same. Like right now, if I see, like, okay, I'm investing 15, like I'll say in the Indian currency, I'm investing 15 lakh, but I'm getting 68 lakhs after 15 years. So right now 68 lakhs is lot, like for me right now, as per the value of the $2,000 bill in India, like 2000, yeah, rupees in India. Right now, 68 lakhs has a very big value, in India. But I don't know, after 15 years, that value will be the same.
Oh,
Probably,
it won't be the same because of inflation,
yeah.
right? So I guess if you take this Reserve Bank words, the inflation is somewhere around 4 to 5%, right?
Mhm.
That is how you can kind of um, calculate what will your money be worth in 15 years.
Yeah.
Yeah, so that's exactly why they give you such a higher interest, because the downside is you cannot take the money out.
Yeah, for 15 years, they said you cannot. And they have legally signed, I've legally signed the documents that I'm not, like, I can't even ask any single penny from the government, from the bank,
Yeah,
until it's 15 years, until the maturity. And
yeah. So remember, in the business world, there's no free lunch, right? They
yeah,
give you high interest in return. You can't take your money out for 15 years.
yes, it's a long period
It
now.
is.
But
Yeah, you better be very careful, right? Because
yeah,
one day, if you really need the money,
yeah.
yeah. So I don't know. I don't give any financial advice, but I think 15 years is a pretty long period of time. Yeah.
Yeah. And then they also, with this, most of the banks nowadays, they also offer insurance kind of thing. So it's like you won't get any interest, but if you have invested 15, you'll get 10 to whosoever is the nominated. Still,
Mm,
you're losing 5, but you'll get 10 anytime anything happens to you. So it's kind of an insurance.
yep. Yeah, yeah. Yeah, you know what? There's another thing, right? I mean, a lot of those insurance policies, you've
Mhm.
got to be very careful
Yeah.
because sometimes people buy it, they think that, um, like I think some kind of policies they are necessary. For example, if you're talking about like a fire protection, right?
Mhm.
That kind of policies is or car insurance, but there are also many kinds of policies that may not be really useful to you, but
Mhm.
insurance companies, because they want to make money, they try to
Yeah.
convince you that, hey, you know what, yeah, you buy it, right? So at the end, it may not be the best to you, so you've got to be very
Yeah.
careful.
Yeah. I just trust it because it's a government bank, and
Okay.
yeah, it's
Yeah.
just that.
Yes, yes, yes. But you know what? I really appreciate you have brought this up, right? Because when we're talking about this kind of policy, this kind of money market, banking system, we're talking about like something that is related to our daily life, right?
Yes.
Yeah, it's not only a theory. Yeah.
Yes. The
So
first question was the first question that I asked, because why here banks don't give high interest in on saving. That question, when I first came to Canada, like in 2018, I was very happy to have my saving account, because I was like, I'll save my like whatever the savings I can, and then I will get some interest on that. And then this is what my like dream looked like back in 2018, but it just shattered because I was like, you don't get this much interest. So
mm.
I had this question in my mind since then, like
Yeah,
to.
you probably need to consider other investment vehicles, right? I mean, saving account, they are safe, but at the
Yeah.
same time, they don't really give you a very good return. Although for the past 2 years, I think the interest rate has already been raised because of the inflation. So the saving account return is already better than, for example, year
Yeah,
2020.
we like it's kind of a better, like you can, the maximum I could see was $50 per month, which was not bad.
Hmm,
But
hmm.
it just depends upon how much saving you have.
Exactly. Yeah.
And then what else? Yeah, I also invested in GIC,
Mhm.
and even that was very similar to what in India they do, like a fixed deposit. I had to, like, the amount was decided by me. Like I can have any principal amount, and I have to um deposited that into a bank for GIC, and then the interest rate was fixed. It's
Mm.
5%. So you can calculate what you will get
Yeah.
after 1 year. But during that 1 year period, um we weren't allowed to like get back that money. So
Yes.
if you want interest,
Yeah,
obviously.
give and take.
Yeah, if you don't want interest, then yeah, you can withdraw at any time. But if you want that interest, you cannot withdraw it within that period of time. Like 1 year was the period. And it's up to us how much we want to invest.
Yeah, yeah, yeah. Yeah, you know what? That's actually a very interesting topic. Yes.
Yeah.
You know what? I came from the finance background.
Mm.
So what you're saying, really interests me.
I'm always curious about investing. So I'm
Yes.
a kind of person who wants $2 from a $1 bill, So
Okay.
it's like
Okay.
multiplying.
Yeah, when we see each other next Wednesday, we can talk more about it.
Oh yeah, sure.
Okay, so does anyone need another break, or should I just keep going? Okay,
Let's keep going.
keep going. Okay, sure. Um, so now let's talk about like one of the major functions of the central bank is to keep the inflation, right, at a certain level. So how exactly can they do it? Now, if you still remember what we've just talked about a few minutes ago, it's not only the central bank that creates money. Commercial banks also create money, because when you deposit money, right, they will lend most of your money to another person, and that person, let's say, deposit that money to the bank, and that will create another round of money. So the calculation is your initial deposit divided by the reserve ratio. So you can think about that. Whenever like you decrease the reserve ratio, the money supply will be created more. Okay, so the lower the reserve ratio, that means the bank doesn't need to keep as much money, the more money is created. Make sense? So remember this formula, okay? The initial deposit divided by the reserve ratio. That would tell you how much new money will be created. Now, the central bank is responsible to what we call the monetary policy. Okay, monetary policy. And that basically is to make sure that the inflation is within a certain range, but the monetary policy can also help to decrease or affect the unemployment. So, like, the monetary policy is one of the two major tools to stimulate or cool down the economy. The process is to change the money supply in the economy as it changes the interest rate. And the change in the interest rate can affect the aggregate demand. That means the overall demand and the GDP. Now, let me ask you a question. It's basically common sense. If I want to cool down the economy to keep the inflation rate lower, should I raise or lower the interest rate?
I think raise.
Exactly, right? Because you don't want to discourage people to borrow money.
Yeah.
So you raise the interest rate, which is to cool down the economy, to curb the inflation. Now, if you see that the economy is doing poorly, right, and the inflation is low, then how do you adjust the interest rate?
Will the interest rate will be decreased.
Exactly. The interest rate
more
will
people can
decrease
borrow
so
money.
that people would be encouraged to borrow more money, to spend, and to invest. That is the basic concept. Now, as a business owner or as a manager, right, that is very important, because when you look at the inflation number, if you see that, oh, the inflation is now very high, you kind of like foresee, because the inflation rate is high, the central bank is not likely to cut interest rate because they want to keep the inflation low. On the other hand, if you hear from the news, the inflation is now very low, and then that probably means the central bank will either cut the interest rate or at least won't further raise the interest rate. So that's why, by looking at the inflation, which is the CPI, for example, you can get a sense how the interest rate policy may change. Make sense?
Yes, Professor.
Yeah. So how does the central bank change the money supply? Okay, there are different ways the central bank can do it. Number one, by changing the reserve ratio, but I don't think that is used very often. Remember, when you force commercial banks to keep more money, you can immediately decrease the money supply. If you lower the reserve ratio, meaning you allow banks to lend more money to people, the money supply grows rapidly. So by changing the reserve ratio is one method of doing it. Number two, by setting the bank rate. The bank rate is the rate at which commercial banks take loans from the central bank. When the bank rate is high, commercial banks are more careful when making the loans, and because of that, money supply grows slowly. And also, because when commercial banks need to borrow money from the central bank at a higher rate, they will tend to charge people who borrow money from them at a higher rate, then that itself would discourage people from borrowing money. The third is called the open market operations, and that is probably the last thing I will talk about today. Now, what does it mean by open market operation? Meaning the central bank can buy and sell the government bonds to change the money supply. Now, if the central bank wants to increase the money supply, right, it can buy the bonds from the market so that more money in return would be moved to the market. On the other hand, if the central bank wants to decrease the money supply, it can sell the government bonds to absorb the money from the market. So what exactly are government bonds? Government bonds are debt. Okay, they are debt. It's basically that the government of Canada would issue the debt certificate to borrow money from the investors. So, for example, Hanit, you talk about investment, right? One possible investment is for people to buy the Canadian bonds. So in this case, you are literally lending money to the Canadian government. In return, they give you interest. That is the bond rate. So this is what the government, like the Canada Premium Bond, looks like. So the central bank can create new money by buying the bonds, okay, so that the money can be moved to the market and more money supply is available. On the other hand, the central bank can sell the government bonds to the commercial banks, to the market, and who in turn would sell the bonds to the customers, and then money supply may then go down. Now, an open market operation is where the central bank buys or sells government bonds on the open market to change the money supply. You can imagine if the Bank of Canada is buying the bonds and expanding the market supply, that would help to stimulate the economy. We call this expansionary open market operation. In return, when the Bank of Canada is selling bonds to absorb the money from the market, we call it the contractionary open market operation. Now, when people decide whether to buy bonds or not, they would compare the bond rate with the interest rate, okay? And they will consider whether bond is a good investment. The price of a bond is the money that buyers of the bonds pay initially. For example, if you look at here, the initial value of the bond is $1,000, and the government of United States guarantees 2% return. Now think about this. If this bond is being sold, but in the market, you can easily deposit money into a saving account and get 4%. Would this bond attractive to you? This bond only gives you 2%, but you can easily get 4% returned from a saving account. So would this treasury bond attractive to you? No. In other words, in order to make it attractive, they have to sell you this bond at a discount so that you're buying this bond not for $1,000, but with a value lower than $1,000. At the end, you get back the interest as well as the $1,000. That should be able to cover or to balance the return that you can earn, for example, from a saving account. So in other words, the interest rate in the market would affect the price of the bond. If the market rate is higher than the bond rate, the bond price would need to decrease. But if the market rate is lower than the bond rate, then that means it's more attractive for people to buy the bonds. The price of the bonds would be driven up. The price of the bond can be over $1,000. Depends on the comparison between the bond rate and the interest and the market rate. So I think that's basically it about the discussion regarding our like our discussion of the of money, the central bank, the banking system, as well as monetary policy and bonds. I wonder if there's any question so far. Now, at the end, I want to quickly go over the learning activity of this week with you. So let me first go to the,
Isn't the learning activity was supposed to do after watching the video?
No, no, actually that learning activity is for last week.
No, you posted one more for the unit 8.
Yeah,
For
I'm going to
project.
show it to you. If you go to the announcement, okay, you see that there's an announcement entitled Learning Activity 8. Okay?
Yeah, and
Now I want to quickly show you what this is. This learning activity is about a speech given by Powell. He is the chair of the Federal Reserve of the United States. Okay? And this is the link that would lead you to his speech. Now, this is not a video, okay? This is a speech that is written. I want you to read this speech, and you should be able to answer the 4 questions that are all related to the speech. Now, in other words, oh, sorry, I forgot to show it to you. Sorry. Yes. Yeah. So first of all, you go to learning, you go to the important announcements, and you should be able to see there's a message, there's an announcement entitled Learning Activity 8. Okay? Now you see from here, there's a link. From this link, you can go to the speech given by Jerome Powell. He is the chair of the Federal Reserve of the United States, and this speech was given very recently. Okay? And then he talked about the interest rate policy, the monetary policy of United States, the Federal Reserve. And these 4 questions, they are all related to the speech. And you should be able to answer all these questions by reading the speech, and the answers can be found from the speech. In other words, I don't think you need to do any extra research. By just reading this article should be good enough for you to answer these 4 questions. Now, I wonder if there's any inquiry, any comment? Is everyone okay?
For now, I don't.
You're okay? How about Hanit?
Yes, 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 yes.
Yes, I've already done it. I think I submitted it 2 days ago or
Very good, very good. Yeah. So I think the whole idea is to ensure that you have read this article.
Yes, and the speech is very easy. It was like when I read it, when I listened to it, I think on Monday or Tuesday this week. It was just 4 days ago. For
very
that
good.
speech. Yeah, and then it is very easy. It's not like a chairperson is giving a speech and it will be like very difficult to understand.
No,
But
I think he did it on purpose because he wanted the general public
yeah,
to understand what the interest rate would look like in the
he's
near
talking
future.
about the inflation and then the interest rates and all that stuff. And but I preferred it listening to it. When you click on the link, it opens the speech. It's in a theoretical form, and then there's a short link over the speech. It says see a video or stuff like that. I don't remember, but it was a it's live, kind of like that was written listen live or stuff like that. So I clicked on it and I listened, I think thrice.
Oh, very good. So it's
Yeah.
up to you. I think it's the same thing. You can either choose to read it or you can listen to it and watch the video. Yeah. Yeah, it should be the same thing. Yes.
Yeah, I've completed it on Wednesday.
Oh, very good. So you know what? I think that's basically it. I wonder if there's any question.
No.
I can't wait to see you all face to face next Wednesday.
Yeah.
Yes. So you know what? I'm going to stop the recording and I'll post this video, okay? As the announcement. Now, if you happen to have friends who cannot come today, let them know this video can be watched very soon.
Okay.
Okay, Professor.
Thank you so much. I know that next Monday is the Labor Day. I hope that you have a very nice long weekend.
Thank
Bye-bye.
Bye,
Bye,
Professor.
bye, brother.